Stop. Put the checkbook down. Close your banking app. I know exactly what you were about to do. You have a little extra cash this month, maybe a bonus, or maybe you've just been incredibly disciplined, and your instinct is screaming at you to take that money and throw it at your mortgage, your car loan, or that student debt. You've been told your whole life that debt is the enemy. You've been told that the only way to financial freedom is to be completely debt-free. But what if I told you that by paying off that debt right now, you might actually be making yourself poorer? What if I told you that the math, the cold, hard, unfeeling math, proves that keeping that debt could be the smartest financial move you ever make? Today, we are going to rewire your brain. We are not going to talk about feelings, we are going to talk about numbers, because the rich play a different game than the rest of us. While the average person obsesses over eliminating debt, the wealthy obsess over managing leverage. There is a massive difference, and if you click away now to go pay that bill, you might lose out on tens of thousands of dollars over the next decade. Stick with me because we are going to calculate exactly why being debt-free is sometimes a trap, and I will show you what you should be doing with your money instead to actually build wealth, not just reach zero. Let's start with the biggest lie in personal finance. All debt is bad. This is the mantra of your parents, your grandparents, and probably that famous finance guru shouting on the radio. And look, I get it. Debt feels heavy. It feels like chains. But in the world of finance, debt is actually a tool. Imagine you're a carpenter. A hammer can smash your thumb, yes, but it can also build a house. Debt is the hammer. If you use it to buy things that lose value, like a luxury vacation or a car that depreciates the second you drive it off the lot, then yes, you are smashing your thumb. That is consumer debt, and it is toxic. But if you use that hammer to build an asset column, the game changes entirely. Here is the concept you need to understand: the cost of money versus the return on money. This is the arbitrage game. Let's say you have a mortgage with a 4% interest rate. Every dollar you use to pay down that mortgage extra early saves you 4% in interest. That sounds good, right? A guaranteed 4% return. But what is the inflation rate? If inflation is hovering around 3 or 4%, the real cost of that debt is effectively zero. The bank is lending you money that is becoming worth less and less every single year. You are paying them back with cheaper dollars in the future. Now imagine you have $10,000. You could pay down that 4% mortgage, or you could invest that $10,000 into a basic S&P 500 index fund, which historically returns about 10% on average over the long term. Let's do the math. If you pay the debt, you save $400 in interest this year. If you invest the money, you earn $1,000. By paying the debt, you just voluntarily lost $600. That is the opportunity cost. And when you compound that over 10, 20, or 30 years, the difference isn't just a few $100, it is hundreds of thousands of dollars. You are literally paying for the emotional comfort of being debt-free with your future retirement fund. But it gets deeper. Let's talk about liquidity. This is the silent killer that nobody warns you about. When you take your cash and throw it into your house to pay off the mortgage, that money is gone. It is trapped in the drywall and the concrete. You cannot go to the grocery store and pay for milk with a brick from your house. You cannot pay for a medical emergency with your home equity unless you go through the slow, painful process of getting a loan or selling the house. And guess when banks tighten up lending? Exactly when you have a financial emergency. So here's the nightmare scenario. You aggressively pay off your debt. You have zero cash in the bank, but hey, your mortgage is lower. Then you lose your job. You have no liquidity. You can't eat your house. Now you're forced to put expenses on a credit card at 25% interest because you buried all your cash in a 4% loan. Do you see the trap? Cash is oxygen. Liquidity is safety. By rushing to pay off low-interest debt, you are suffocating your financial flexibility. I want you to think about businesses. Apple, Amazon, Microsoft. These companies have billions of dollars in cash, yet they still borrow money.
Why? Because they know they can take that borrowed money, invest it in their business, and make a return that is far higher than the interest rate on the loan. They are using other people's money to get rich. You need to start thinking like a CEO of your own life. You need to stop looking at debt as a moral failing and start looking at it as a mathematical variable. Now, I can hear you screaming at the screen, but what about risk? The stock market can crash. You're absolutely right. And that is why this strategy requires a system, not just blind gambling. We are not talking about taking your rent money and putting it into a meme coin. We are talking about calculated, long-term wealth building. There is a specific threshold, a specific number that determines whether you should pay off a debt or invest. This is the wealth line. If your debt interest rate is below this line, you pay the minimum. If it is above, you attack it. In the next part, I'm going to give you that exact number. I'm going to show you the step-by-step priority list of where every single dollar should go starting from today to maximize your net worth. We are going to break down the toxic debt versus wealth debt and give you a blueprint that could retire you 5 years earlier.
So, what is the magic number? What is the wealth line that separates a smart debt from a toxic one? In the current economic climate, that number is 6%. This is your new compass. If you have a debt with an interest rate above 6%, that is an emergency. That is a fire in your kitchen. Credit cards at 20%, personal loans at 12%, or a predatory car loan at 9%. You need to attack these with everything you have. Why? Because paying off a 20% credit card is exactly the same as getting a guaranteed tax-free 20% return on your money. Warren Buffett can't even guarantee that. So yes, in those cases, debt is the enemy. Kill it. But, and this is the but that makes you rich, if your debt is under 6%, like that 3% mortgage or a 4% student loan, you need to slow down. You make the minimum payments, only the minimum. Every single extra dollar you were planning to throw at that debt needs to be redirected into assets that grow. Let's look at the order of operations for your money. This is the blueprint I promised you. If you follow this checklist, you are mathematically optimizing every dollar that enters your bank account. Step 1 is the Sleep Well at Night Fund. Before you invest and before you pay off extra debt, you need a cash cushion, 3 to 6 months of expenses in a high-yield savings account. Not under your mattress and not in a checking account earning 0.01%. Put it where it earns 4 or 5% interest. This fund protects your investments. If your car breaks down, you don't have to sell your stocks or go into credit card debt. You use the cushion. This is your liquidity. Step 2 is the free money grab. If your employer offers a 401k match, you take it. If they match up to 3% of your salary and you don't contribute, you are literally rejecting a 100% return on your money instantly. There is no investment on earth that beats an employer match. Do not pay off a single dime of extra debt until you have maxed this out. Step 3 is the toxic cleanup. Now you go after that debt above 6%, the credit cards, the bad loans. Use the avalanche method. Pay off the highest interest rate first. This is where you are aggressive. This is where you eat rice and beans if you have to. Get the high interest weight off your shoulders. Step 4 is where the magic happens. This is the arbitrage zone. You have your emergency fund, you got your match, and your high-interest debt is gone. All you have left is the low-interest mortgage or student loans. Do not pay them off early. Instead, max out a Roth IRA. Put money into a low-cost S&P 500 index fund. Let's say you have an extra $500 a month. If you put that into your 4% mortgage, you save a little interest. If you put that into the market, earning an average of 10%, you are capturing a 6% spread. That 6% spread compounded over 20 years is the difference between retiring in comfort and working until you are 75. I know what some of you are thinking, but it feels better to be debt-free. I understand that emotion. The psychological weight of debt is real.
If you lose sleep at night because you owe money on your house, then go ahead and pay it off. But understand that you are buying a luxury product. You are purchasing peace of mind, and the price tag is hundreds of thousands of dollars in lost future growth. If you are okay with that price tag, pay the debt. But if you want to be wealthy, you have to prioritize math over emotion. Think about inflation one last time. In 30 years, the payment you are making on your mortgage today will feel like pocket change because the dollar will be worth less. The bank is stuck receiving those devalued dollars while your investments are growing with inflation. You are winning on both sides. You are paying back with cheaper money and earning on growing assets. Financial freedom isn't about having zero liabilities. It is about having assets that vastly outweigh your liabilities. It is about control. When you send your money to the bank to pay off a loan, you lose it control forever. When you invest it, you keep control. You can sell the stock if you need to. You have options. And in life, options are wealth. So, here is your challenge for this week. Look at your debts. Write down the interest rates. Draw a line at 6%. Stop overpaying the ones below the line. Take that money, open a brokerage account, and start buying your freedom one share at a time. Stop trying to get to zero. Start trying to get to infinity. You have the math. You have the blueprint. Now you just need the discipline to ignore the noise and execute the plan. Don't let fear dictate your financial future. Let the numbers lead the way.